Most traders believe that success in the market comes from seeing more than others. They believe that if they study harder, analyze deeper, or react faster, they will finally gain control over outcomes. When they struggle, they assume something external is missing: a better system, a clearer signal, a sharper confirmation. They believe the discomfort they feel during a losing trade is evidence that their analysis was incomplete. What they rarely consider is that the discomfort is not a flaw in their strategy. It is a response from their nervous system to uncertainty. When you enter a trade, something subtle changes inside you. Your breathing tightens slightly. Your attention narrows. Your body shifts from observation to involvement. The position is no longer abstract. It is personal. Even if the size is small, even if the risk is defined, the mind begins to calculate outcomes. It begins to imagine loss. It begins to imagine being wrong. This reaction is automatic. It is not weakness, it is biology. The market moves a few points against you and your chest contracts. It moves in your favor, and a quiet surge of relief spreads through you. These reactions feel harmless, but they distort perception. Fear makes small pullbacks appear dangerous. Hope makes weak bounces look like reversals. You are no longer reading the chart. You are reading your own internal state and projecting it onto the screen. Most traders think they lose because they misread structure. In reality, they mismanage their nervous system. The amateur believes trading is about reacting correctly to movement. He watches every candle as if it demands a response. He feels productive when he is active. He feels intelligent when he identifies something to do. Inaction feels like failure. Sitting in cash feels like missing out. Silence from the market feels like a threat to identity. But the professional understands something quieter and far less dramatic. Most movement does not matter. Most days do not contain opportunity that justifies risk. The body may crave stimulation, but the account does not require it. The ability to sit still when nothing meaningful is happening is not laziness. It is regulation. When traders overtrade, it is rarely because they see too many good opportunities. It is because they cannot tolerate the tension of waiting. The mind interprets uncertainty as a problem that needs to be solved immediately. So it finds a reason to act. A small breakout becomes a signal. A minor pullback becomes an entry. The decision feels rational, but underneath it is relief. Relief from not knowing. Relief from doing nothing. This is where discipline begins. Not at the moment of entry, but in the willingness to remain neutral when neutrality is appropriate. The nervous system is built to respond to movement. Sudden price shifts resemble threat. Rapid gains resemble reward. In evolutionary terms, movement demanded attention. In markets, most movement is noise. Yet your body does not know that. It responds as if survival is at stake. Heart rate increases. Muscles tighten. Thought accelerates. The mind searches for certainty. If you have not trained yourself to recognize this activation, you will mistake urgency for insight. You will call impulse conviction. You will label anxiety intuition. A regulated trader experiences the same physiological signals as everyone else. The difference is not the absence of emotion. It is the interpretation of it. He feels the tension and understands it does not require action. He notices the urge to exit early and recognizes it as discomfort, not structural change. He allows the sensation to pass before making decisions. This is why survival comes before profit. If you cannot remain stable during temporary discomfort, you will never hold a position long enough for probability to play out. You will take small gains and large losses. You will exit structure because of noise. You will abandon your own plan in moments of stress. Small position size is not about fear. It is about clarity. When risk is small enough that the body does not interpret fluctuation as danger, perception improves. You can observe without panic. You can hold without bargaining. You can exit without shame. Large size magnifies emotion. It compresses thinking. It reduces flexibility. It turns normal pullbacks into personal threats. Many traders attempt to solve emotional instability by refining their strategy. They add indicators. They search for better entries. They tighten rules. But instability is rarely technical. It is physiological. A perfect setup executed in a dysregulated state will still be mismanaged. There is a moment in every trade when discomfort appears. Price pulls back slightly. A candle closes against you. Volume shifts. Nothing structurally significant has changed, yet something inside you reacts. That moment determines your long-term outcome more than the entry itself. If you interpret that discomfort as information, you will act prematurely. If you interpret it as a stress response, you will pause. Professional trading is not about suppressing emotion. It is about designing a process that does not depend on emotional stability in the moment. You decide in advance where you are wrong. You decide in advance how much you are willing to lose. You decide in advance under what conditions you will hold. When the moment of tension arrives, the decision has already been made. This is not rigidity. It is protection from cognitive distortion under stress. Hope and fear are not occasional visitors in trading. They are constant companions. Hope whispers that a losing position will recover if you just give it more time. Fear whispers that a winning trade will collapse if you do not secure profit immediately. Both feel persuasive because they are aligned with the desire to avoid pain. But the market does not respond to hope or fear. It responds to collective order flow and structural forces beyond your control. Your responsibility is not to feel correctly. It is to act consistently with your plan. The amateur measures effort by activity. He believes that if he is not trading, he is falling behind. The professional measures effort by adherence to process. He understands that doing nothing when nothing meets criteria is productive. Capital preserved is opportunity retained. Mental energy conserved is clarity protected. Boredom is often misinterpreted. For the unregulated trader, boredom creates anxiety. It suggests missed opportunity. It pushes him to lower standards. For the regulated trader, boredom is neutral. It means the market is not presenting alignment. That is acceptable. Markets are not obligated to provide daily opportunity. Waiting is not passive. It is active restraint. It is observing fluctuations without attaching meaning prematurely. It is allowing patterns to develop fully before committing risk. It is respecting probability over impulse. When you sit through a temporary drawdown in a well-planned position, and your body may interpret it as danger, your heart rate may rise, thoughts may become urgent. This does not mean the trade is invalid. It means you are experiencing exposure to uncertainty. Exposure, when managed with appropriate size and preparation, builds tolerance. Over time, regulated exposure reduces reactivity. The same fluctuation that once triggered panic becomes manageable. This is not because the market changed, it is because you did. Identity plays a larger role than most traders admit. Loss feels like a statement about competence. A stopped-out trade can feel like proof of inadequacy. This is why some traders move stops or add to losers. They are not protecting capital. They are protecting ego. When identity is fused with outcome, regulation becomes impossible. Every tick becomes personal. Every drawdown becomes humiliation. Every loss becomes threat. The professional separates identity from result. A losing trade executed correctly is not failure. It is cost. A winning trade executed poorly is not success. It is luck. This shift from outcome focus to process focus is fundamental. It stabilizes behavior across winning and losing periods. It reduces emotional volatility. It creates consistency. Markets are uncertain by nature. Preparation does not guarantee reward. Effort does not ensure profit. This reality conflicts with conditioning from other areas of life where hard work correlates with outcome. In trading, probability replaces certainty. You can do everything correctly and still lose. Accepting this intellectually is easy. Accepting it emotionally is difficult. The nervous system seeks predictable reward. When effort does not immediately produce gain, frustration emerges. Without awareness, That frustration turns into revenge trading, overtrading, or abandonment of plan. Regulation requires tolerance for randomness. It requires viewing each trade as one instance within a larger series. It requires understanding that edge expresses itself over time, not immediately. The professional does not try to control the market. He controls exposure. He controls size. He controls process. He understands that stability over hundreds of trades matters more than intensity in a single one. Many traders search for confidence. They believe confidence will eliminate fear. True confidence is not absence of discomfort. It is familiarity with it. It is knowing that temporary stress does not require deviation. The market does not reward excitement. It does not reward constant engagement. It rewards disciplined participation aligned with structure and managed through emotional regulation. When you begin to see trading not as a battle to be won, but as an environment requiring self-management, everything changes. The chart becomes less threatening. Fluctuations become data instead of danger. Waiting becomes strength instead of weakness. The transition from reactive trader to regulated professional is quiet. It is not dramatic. It does not feel like sudden mastery. It feels like reduced urgency, reduced need to prove, reduced impulse to act. Over time, small stable decisions compound. Small controlled risk builds resilience. Small consistent adherence to plan builds trust in yourself. That trust is the foundation of sustainable performance. The goal is not to predict perfectly. The goal is to remain stable enough for probability to work in your favor. Survival allows compounding. Emotional stability allows survival. Trading psychology is not separate from execution. It is execution. Most traders assume that once they understand structure, once they can identify trends and key levels, emotional difficulty will disappear. They believe knowledge eliminates instability. Yet even with a clear plan, the moment money is at risk, the body responds as if something essential is threatened. This is where many disciplined analyses collapse under pressure. When a position begins to fluctuate, the mind searches for certainty. It wants immediate reassurance that the decision was correct. If price hesitates, doubt forms. If price accelerates against the position, the body tightens. Thoughts become urgent. The internal dialogue shifts from observation to self-protection. You are no longer calmly assessing probability. You are negotiating with discomfort. This negotiation is subtle. You might tell yourself you are being prudent. You might say you are locking in gains responsibly. You might justify moving a stop because conditions feel different. But often, the underlying driver is the same. A desire to reduce emotional tension as quickly as possible. The nervous system does not distinguish between financial uncertainty and physical threat very well. Both activate similar responses. Increased heart rate, narrowed focus, heightened vigilance. In moderate amounts, this sharpens awareness. In excess, it distorts interpretation. You begin to see patterns that confirm your emotional state rather than objective structure. If you are afraid, you will find evidence that danger is increasing. If you are hopeful, you will find evidence that recovery is imminent. The chart becomes a reflection of your internal condition. Regulation begins with recognizing this mechanism without judgment. You are not weak for feeling stress. You are human. The problem is not activation itself. The problem is acting from activation without pause. Professional traders build distance between sensation and action. They feel the surge of anxiety and allow it to settle before modifying anything. They trust predefined rules over real-time emotion. This creates stability during moments when the mind is least reliable. There is also a deeper psychological layer. Many traders unconsciously trade to validate identity. They want to see themselves as skilled, decisive, superior to the crowd. When a trade moves against them, it threatens that identity. Instead of exiting according to plan, they defend the position to defend themselves. They add size. They widen stops. They reinterpret data. This is not about greed. It is about ego preservation. The shift from emotional trader to regulated professional requires releasing the need to be right. You are not here to prove intelligence. You are here to execute a probabilistic process. Being wrong is built into the business. The only unacceptable mistake is abandoning discipline. Small position size supports this transformation. When risk per trade is modest, the ego is less threatened. A loss does not feel catastrophic. It feels manageable. This allows honest assessment instead of defensive reaction. With large size, every tick feels amplified. Regulation becomes fragile. Clarity disappears. Many traders underestimate how much size influences perception. They believe they can simply control emotion through willpower. But physiology responds to magnitude of exposure. Reduce exposure and perception stabilizes. Increase exposure beyond tolerance and even the best plan will fracture. Another overlooked element is cumulative decision fatigue. Watching every movement, reacting to every fluctuation, making constant micro-decisions drains cognitive resources. By the time a genuine opportunity appears, mental energy is depleted. Execution suffers not because of lack of skill, but because of exhaustion. Selective engagement preserves clarity. Not every movement deserves attention. Not every candle demands interpretation. Protecting attention is protecting capital. The concept of waiting is often misunderstood as inactivity. In reality, it is structured observation. It is allowing context to develop fully before committing. It is accepting that uncertainty cannot be eliminated, only managed. When traders overanalyze minor fluctuations, they create unnecessary emotional cycles. Each small move generates hope or fear. Each reaction consumes discipline. Over time, this erodes consistency. The professional limits exposure to noise, fewer signals, clear criteria, defined structure. Simplicity supports regulation. There is a quiet confidence that develops when you trust your process more than your feelings. It is not loud or aggressive. It is steady. You no longer need to catch every move. You no longer feel threatened by missing out. You understand that survival and consistency matter more than frequency. This mindset also changes how you experience losses. Instead of immediate self-criticism, you evaluate execution. Did I follow my rules? Was my size appropriate? Did structure invalidate the idea, or did emotion interfere? This evaluation is calm, not punitive. Punishment does not create discipline. Awareness does. The market is indifferent. It does not reward effort alone. It does not compensate emotional intensity. It distributes outcomes according to probability and positioning. Accepting this removes resentment. There is no enemy to fight. There is only your process to refine. Revenge trading often emerges when traders feel treated unfairly by randomness. A string of losses feels personal. The impulse to recover quickly intensifies. Size increases. Criteria loosen. The nervous system is fully activated. Decisions accelerate. This is rarely about strategy. It is about emotional regulation failing under accumulated stress. A regulated trader recognizes escalation early. After a loss, he pauses. He resets physically. He assesses calmly. He does not allow the previous outcome to dictate the next decision. Each trade is independent within the series. Series thinking is essential. A single trade means little. 10 trades mean more. 100 trades reveal edge. If you anchor emotionally to individual outcomes, volatility in performance will mirror volatility in feeling. Stability comes from zooming out mentally. The shift from outcome focus to process focus is not passive acceptance. It is disciplined alignment with probability. You cannot control which individual trade wins or loses. You can control whether you execute consistently across the series. As this understanding deepens, urgency decreases. You stop needing immediate validation. You become comfortable with gradual progress. Growth becomes measured and sustainable, rather than dramatic and unstable. Professional identity forms quietly. It is defined by restraint, by selective action, by calm exits, by appropriate size, by consistency and routine. It is less about brilliance and more about stability. When a major structural opportunity appears, the regulated trader is prepared, not because he has been hyperactive, but because he has preserved capital and clarity. He can commit without desperation. He can hold without panic. He can exit without regret. This is the paradox. The less you need the market to perform for you emotionally, the more effectively you can participate in it financially. Emotional neutrality does not mean indifference. It means balanced engagement. You care about execution. You respect risk. But you are not consumed by every fluctuation. Over time, the nervous system adapts to uncertainty through repeated regulated exposure. Drawdowns that once felt intolerable become manageable. Waiting that once felt unbearable becomes normal. This adaptation is earned through disciplined repetition, not sudden insight. Most traders quit before this adaptation occurs. They interpret discomfort as evidence that trading is not for them. In reality, discomfort is part of the conditioning process. With proper size and structured rules, exposure builds resilience. The path from reactive participation to stable professionalism is gradual. It requires humility. It requires accepting that your greatest obstacle is rarely the market itself. It is your reaction to it. When you understand this fully, the chart becomes less emotional. It becomes information within a framework. You engage when criteria align. You disengage when they do not. You allow losses without collapse. You allow wins without euphoria. Consistency emerges from this balance. The goal is not to eliminate emotion. It is to prevent emotion from dictating action. When action is dictated by plan rather than impulse, performance stabilizes. Stability compounds. Small disciplined gains accumulate. Capital grows steadily. Confidence grows quietly. Identity shifts from emotional participant to regulated professional. And that shift is where sustainable trading begins. There is another misconception that quietly undermines many developing traders. They believe that intensity equals commitment. If they feel deeply, if they think constantly about their positions, if they monitor every fluctuation, they assume they are being serious. In reality, intensity often signals insecurity. The need to constantly check, adjust, and reinterpret reflects discomfort with uncertainty. A regulated professional does not need to hover over every tick. He defines his levels, sets his risk, and allows space for the trade to evolve. This space is not negligence. It is trust in preparation. When preparation is thorough, constant interference becomes unnecessary. The nervous system prefers closure. It prefers clear resolution over open loops. An active trade is an open loop. It remains unresolved until exit. This unresolved state creates subtle psychological pressure. The mind wants to close it quickly, either by taking profit or cutting loss prematurely. Both actions provide relief. Relief feels like control, but relief is not the same as optimal decision-making. Learning to tolerate open loops without rushing to closure is a skill. It strengthens over time through repeated disciplined exposure. Each time you remain aligned with your plan despite discomfort, you reinforce stability. Each time you override your plan to reduce tension, you reinforce impulsivity. There is also the matter of comparison. In the modern environment, traders are constantly exposed to others claiming large wins, rapid gains, dramatic success. This creates a distorted benchmark. Patience begins to feel slow. Steady growth feels inadequate. The urge to increase size or frequency intensifies, not because your plan requires it, but because your ego feels pressured. Comparison is destabilizing because it shifts focus away from personal process and toward external validation. The professional measures progress internally. Am I following my criteria? Is my risk consistent? Is my behavior stable across outcomes? These metrics matter more than any single profit figure. Another destabilizing factor is inconsistency in routine. When sleep is irregular, when lifestyle is chaotic, when physical health is neglected, emotional regulation weakens. Trading performance cannot be separated from overall physiological state. Fatigue lowers tolerance for uncertainty. Stress outside the market amplifies reactivity inside it. This is rarely discussed in strategy-focused conversations. Yet stability in life supports stability in trading. A calm body produces clearer decisions. A rested mind resists impulsive reactions. Professionalism extends beyond charts into daily habits. There is a quiet discipline in ending the trading day correctly. Not chasing late setups to compensate for earlier inactivity. Not forcing trades to avoid the feeling of an unproductive session. Accepting that some days are simply observation days. Closing the platform without resentment. This reinforces the identity of a process-centered operator rather than an outcome chaser. When a trader becomes process-centered, wins no longer inflate ego excessively, and losses no longer collapse confidence entirely. Emotional amplitude decreases. This reduced amplitude allows clearer pattern recognition. You see structure more objectively because you are not seeking emotional payoff from each move. Long-term survival depends more on avoiding large mistakes than on capturing every opportunity. Large mistakes usually occur during emotional spikes. Oversized positions, ignored stops, revenge trades, overconfidence after a winning streak, fear-driven liquidation after a minor pullback. These moments cause disproportionate damage. Regulation dampens these spikes. It introduces pause. It creates space between impulse and execution. Often that space is only seconds long, but it is enough to prevent deviation from plan. Professional restraint is not rigid stubbornness. It is flexible within predefined boundaries. If structure genuinely changes, the professional exits without drama. There is no attachment to being correct. There is no narrative about betrayal by the market. There is simply adaptation to new information. Adaptation requires humility. You must accept that your analysis can be invalidated. This acceptance reduces defensiveness. When you are not defending identity, you can adjust more fluidly. Many traders think confidence means certainty. True confidence in markets is comfort with uncertainty. It is acting despite incomplete information because you trust your risk parameters. It is knowing that any single outcome is random, but the process over time is not. This perspective transforms drawdowns. Instead of emotional crises, they become statistical events within a distribution. You still evaluate them seriously, but without panic. You assess whether behavior changed or whether variance is unfolding normally. Variance is uncomfortable because it challenges the illusion of control. You may execute perfectly and experience several losses in a row. Without psychological preparation, this triggers doubt. You question the edge. You search for new systems. You abandon consistency. In doing so, you disrupt the very probability you intended to rely on. Stability during variance separates sustainable traders from those who cycle endlessly between enthusiasm and frustration. The identity shift from reactive to regulated does not eliminate ambition, it refines it. Ambition becomes long-term. It seeks durability rather than spectacle. It values steady compounding over rapid spikes. Compounding is quiet. It rarely produces dramatic stories. Oh no. It produces incremental progress built on disciplined repetition. This is less emotionally exciting but far more sustainable. There is also the matter of honesty. After each trade, you must be honest about whether you followed your plan. If you did, accept the outcome fully. If you did not, acknowledge it without self-punishment, but with firm commitment to correction. Avoid rationalization. Rationalization preserves ego but destroys improvement. Our professional growth is rooted in clear feedback loops. Execution is either aligned or not. Outcomes are secondary to alignment. As regulation strengthens, something subtle happens. The market begins to feel slower, not because it has changed, but because urgency inside you has decreased. You no longer feel pulled by every fluctuation. Time perception shifts when emotional arousal decreases. Decisions become measured. Measured decisions reduce error frequency. Reduced error frequency protects capital. Protected capital allows continued participation. Continued participation allows edge to express. This chain begins with emotional regulation, not superior prediction. Many aspiring traders search for breakthrough moments. In reality, transformation often appears as reduced drama, fewer impulsive entries, smaller drawdowns, more consistent sizing, clearer daily routines, greater emotional neutrality. These changes may seem unimpressive externally, but internally they represent structural maturity. Trading at a professional level is less about constant action and more about selective precision. It is less about emotional highs and more about controlled engagement. It is less about proving intelligence and more about managing behavior. When you reach this stage, the market is no longer an arena for emotional expression. It becomes an environment for disciplined execution. You participate when conditions align. You withdraw when they do not. You respect probability. You accept uncertainty. You protect capital. You protect clarity. Over years, this approach builds not only financial growth, but psychological resilience. The skills developed extend beyond trading. Tolerance for ambiguity, patience under stress, detachment from immediate validation. These qualities strengthen decision-making in all areas of life. The transformation is gradual. It requires repeated exposure to discomfort managed correctly. It requires humility to accept mistakes. It requires commitment to small, consistent improvements. But once established, this regulated foundation makes trading sustainable. At the deepest level, trading is an environment that exposes how you relate to uncertainty. It does not create your tendencies. It reveals them. If you avoid discomfort in other areas of life, you will try to avoid it in positions. If you chase stimulation elsewhere, you will chase it in the market. The screen becomes a mirror. Many traders interpret repeated emotional reactions as proof that they are not suited for this field. In reality, those reactions are invitations to develop regulation. The market is simply faster and more precise at exposing instability than most environments. It provides immediate feedback. That feedback can feel harsh, but it is accurate. When you begin to understand that your primary task is self-management, priorities shift. You no longer obsess over perfect entries. You obsess over consistent behavior. You track whether you honored size limits. You track whether you respected predefined exits. You track whether you waited for alignment instead of manufacturing opportunity. This shift reduces internal conflict. You are no longer battling the market. You are refining your process. There is a calm strength that develops when you truly accept that losses are operational costs. You stop negotiating with them. You stop taking them personally. You allow them to occur within parameters. This acceptance prevents the spiral of anger and revenge that destroys accounts more than poor analysis ever could. Likewise, you begin to treat winning with caution. Excitement is monitored. After strong gains, the impulse to increase size aggressively is recognized as emotional expansion rather than strategic necessity. You maintain proportionality. You respect risk even when confident. Emotional symmetry is critical. If losses devastate you and wins inflate you, behavior will oscillate. Stability requires narrowing both extremes. Moderate response to loss. Moderate response to gain, consistency across states. There is also the matter of time horizon. Reactive traders focus on immediate results. Regulated professionals think in quarters and years. They understand that durability outweighs short-term fluctuation. This longer frame reduces urgency. Reduced urgency improves decision quality. Small advantages repeated consistently compound more reliably than occasional dramatic successes followed by large setbacks. The mathematics of growth favors steadiness. Emotional steadiness supports mathematical growth. As you mature in this process, the urge to predict every movement fades. You accept that clarity often appears gradually. You allow trends to establish themselves. You avoid forcing interpretation on incomplete data. This patience protects you from unnecessary exposure. When conditions are unclear, staying flat is a decision. It is not weakness, it is active risk management. Protecting capital during low probability periods ensures availability during high probability periods. Over time, confidence shifts from prediction accuracy to execution reliability. You trust yourself to act according to plan, regardless of emotional state. This trust reduces anxiety before entry because you know you will handle whatever unfolds within your predefined structure. Even during challenging periods, this foundation prevents collapse. Drawdowns are managed, adjustments are measured. You review data calmly rather than abandoning approach impulsively. Improvement becomes incremental and thoughtful. The professional mindset is quiet. It does not require validation from others. It does not broadcast every win. It does not dramatize every setback. It focuses on sustainable alignment between strategy, risk, and psychology. At this stage, the market feels less like an adversary and more like an environment. Weather changes, volatility expands and contracts, trends form and dissolve. You respond appropriately without personalizing conditions. The identity shift is complete when your sense of worth is no longer tied to daily profit and loss. You see yourself as an operator executing a process within uncertainty. Some days produce profit, some produce loss. Both are neutral events within the broader trajectory. This neutrality frees cognitive resources. Without emotional turbulence, analysis becomes clearer. You notice structural shifts earlier because you are not distracted by internal noise. You exit invalid ideas faster because ego is not involved. You hold valid ideas longer because fear is regulated. Risk becomes something you measure, not something you fight. Exposure is intentional. Size is deliberate. Stops are respected. Adjustments are rational. Most importantly, you understand that survival is the foundation of all growth. If capital is preserved and behavior is consistent, opportunity can be exploited repeatedly. If capital is destroyed through impulsivity, opportunity becomes irrelevant. The transformation from emotional trader to regulated professional is not marked by a single breakthrough trade. It is marked by hundreds of small disciplined decisions. It is visible in position sizing that remains constant during stress. It is visible in exits that follow plan even when hope argues otherwise. It is visible in days when you do nothing because nothing meets criteria. In the beginning, restraint feels restrictive. Later, it feels liberating. You are no longer compelled by every fluctuation. You choose when to engage. You choose when to wait. This autonomy is rooted in regulation. Trading will always involve uncertainty. Markets will always fluctuate. Losses will always occur. What changes is your relationship to these realities. Instead of resisting them emotionally, you integrate them into your expectations. When you integrate uncertainty, fear decreases. When fear decreases, clarity increases. When clarity increases, execution improves. When execution improves, results stabilize. Stability does not mean constant profit. It means consistent behavior regardless of outcome. And consistent behavior aligned with positive expectancy is what ultimately produces growth. In the end, professional trading is not dramatic. It is structured, it is repetitive, it is calm, it is built on preparation, controlled exposure, honest review, and emotional regulation. The market does not demand perfection. It demands consistency. It does not require brilliance. It requires discipline. It does not reward intensity. It rewards stability. When you internalize this, you stop chasing excitement. You start building resilience. You stop reacting impulsively. You start executing deliberately. You stop measuring success by single outcomes. You start measuring it by adherence to process. That is the quiet evolution from reactive participation to regulated professionalism. And that evolution, sustained over time, is what allows probability to work in your favor.